Okay, folks, welcome to Market Trends. We'll be starting in a few seconds. Hope everyone is having a good Thursday. All right, here we have our disclosures. Please look at them. As usual, go to TradeStation.com and then go to the Research tab at the top, and then go to the Insights selection. That will take you to a Market Insights blog. On the Market Insights blog, you will see a story at the top called Market Trends, as usual, and that is our link for today. We've made a small addition to our zip file, so check it out. We have a new zip file. Let's go here very quickly. TradeStation.com, Research, Insights, and here you will see S&P struggles before payrolls report. Here we go. So for the new download, go here, and there's one addition I'm just going to show you. When you go to this zip file and you open it up, it's going to bring you to this folder called Public Materials. And now inside of that, I've added one thing, LT debt ratios ELD. And that's a new indicator I'm going to show you guys. It's just a refinement. You know, with everything getting hammered based on debt, it's a good time to kind of revisit that. All right, so look at the overall situation here at the S&P. You know, in my view, we got right now, we're just sitting and waiting. Today's price action is kind of weird because we actually have an inside day. Let me go to this chart here. The S&P, for example. And the S&P, we can see it is basically, it was interesting. I noticed this yesterday, we had an inside day, but today we have another inside day. So the price action of today is inside of this day. If we look at our blog post here, there's a few things I want to point out. That basically there's this level right around 4,200. It's like a nice round number, but in my view, I don't really see a huge amount of relevance to it. When you really look at it, it's kind of a high, but you know, when the market is going down, you have to be careful assuming that old highs are going to become new support. You know, just because this was a high, it doesn't always mean anything. And so I think right now, if you're looking for support, might need to look down deeper toward 4,100. This was a nice level where we bounced right at the end of May. You know, below that, we had another 50 points down. So I think that right now, this is, we have to be kind of realizing that there's really no clear support here. I don't have it on this chart, but we also, the 200-day moving average is right kind of below us as well here. Let's look on this chart. And we have on this chart, I'll just show you this line now, to me, is kind of a weekly thing that I'm becoming aware of. You know, it's a lower high than we had back at the end of the beginning of last year, the end of 21. So now we have these lower weekly highs. And if you look at these levels, we tried to hold 4,300 was this level right here. I mean, around 4,330. This was the high from August of 2022. We bounced there late June, bounced there mid-August, tried and failed to hold it. And now another level that's coming into play, and we talked about it last week, and we did bounce at it. Last week, we were talking about this level around 40, what was it? It was like 4230-ish, right around here. I'm sorry, 4260-ish. This was this kind of, we had this breakout back in June, early June, and then we went rallying the new 52-week highs, but we were basically holding around that time 4261 area. And that kind of came down, and it's interesting, you see we held it on the 26th. We went under it, had a nice, hammer, came back and had like a 2-day follow through, and then that was it. We tried to hold it kind of again here, but now you can see this level right on 4260. Where are we failing? Inside day, that was exactly pretty much where we closed yesterday. This close from yesterday was almost exactly on that line, support becoming resistance again today. So these things to me tell me the market is just kind of squeezing in here. And I think that the big thing now is that we're pretty much holding our breath for the payrolls report tomorrow. I think that a strong payrolls report could bring out some more selling and kind of, hammer things down. And all right, let me just see if there's some other points here I want to make about this. It's also interesting that if you go to our MT breadth, you can see that we're starting to have more lows in the 52 in the S&P 500. So this will show us a number of lows. Recently went up to the highest level almost in a year, since mid-October of last year. So, we're starting to see just more and more just sort of weakness in things. And the thing is that if you look at it, we haven't had any kind of like real evidence of capitulation or a maxed out selling or anything like that. So I think right now we need to remember, obviously, payrolls tomorrow, but after that, and it might be just as important, Fed minutes, and then the CPI. PPI is also on the 11th, which is Wednesday of next week. This is debatable. Is it PPI? It's weird that PPI is before CPI this month. But the thing is that we have PPI on that morning. Then we have Fed minutes at 2 o'clock that afternoon on the 11th, and then CPI the next day. So to me, we have these series of events. And I would tend to think that October is going to fall into two halves. The first half is the macro half. The second half is the earnings half. And then somewhere in here, we are going to see the macro Fed interest rate phase of October end, and we're going to turn to earnings. So I think we need to kind of think that way. That's could be the way things kind of play out. Now, another thing here is if you actually look at junk spreads, I think I have this. This is a high yield spreads. What's interesting to me is that this is starting to widen now. So I think we're entering a phase here. I've said all along that I didn't think a recession was possible, but I'm starting to think recession is now it's starting to seem more likely at some point, because we're starting to see real evidence when you look at things that are coming from S&P and their credit rating people and some other places. Credit card delinquencies going up. We're starting to see moves and things now that are talking bankruptcies, defaults, stuff like that. And I mean, look what's happened in the last week to utility stocks. I mean, this has been a complete carnage. Look at Coca-Cola today, by the way. I just can't believe this. It's trading. I mean, we've been talking about these branded consumer product stocks having troubles. We talked about this bearish, triangle up here. And it's just kind of this is another one on that list. But this was it. We basically said there are these companies that have assets. They funded them at a time when interest rates were 2%. Now interest rates are 5 to 8%. You look into the future and you say, well, if I'm a utility stock, for the next 10 years, I've been basically terming out all of my debt at super low rates. What does that mean? It means that if I issued 10-year notes 4 years ago, they come due in 6 years. If I issued them 4 years ago at like 2.5%, now they're going to come back and they're going to be at like 8% or 7%. So your entire universe of interest expense is going higher across this entire universe of companies. And that's what we're seeing now with the utility stocks. We're seeing it in things that are leveraged, and that's the indicator I wanted to show you today. But I think it's interesting to see this in companies that have this kind of debt or anything that has these kind of long-term assets. That was what really struck me about the consumer staples, like a name like Coca-Cola, is you have a company that basically has a long-term asset people thought was worth X, but it's actually worth less. And then on top of being worth less, the debt that is used to finance those assets, even though it's not a huge amount with Coca-Cola, that debt is now more expensive, or it will be into the future. And if you're modeling companies like this that have interest expense, all of those are getting marked up on the income statement going forward, which means it's marking down that income for the foreseeable future. And that's happening now across the entire S&P. We talked back in June. I remember the time we were saying these leveraged financials, the leveraged cyclicals, like the cruise ships. We had kind of talked about this upside that was coming at that point in the cruise ship, the airlines back in June, Carvana, stuff like that. Now it's the opposite of all of that is happening. The leverage companies are now looking out to the future, and they're seeing a lot of pain. So that is, I think, really the big trend we have to kind of be thinking about. But I think it's important to look here at junk spreads are really starting to widen this time. And I think that this is kind of a more significant thing because we're starting to see it in the credit card charge-offs and other things like that. And I think at this point in time, we're actually more in a point now of potentially getting to that spot when recession could actually be more of a real possibility. I have not believed it until now, but I don't think that the kind of carnage we've seen at the long end of the curve in terms of rates and stuff is going to cause some things that look more like a recession, and more of a paralysis and things like the housing market. And when you look out into the future and you see the commercial real estate and everything else coming due, it's really hard to not see pain increasing and some troubles there. All right. But there's some other interesting things happening. In my opinion, what's happening amid all this, and the Fed, in my view, it's interesting because I think a lot of what the Fed was trying to do when they changed their dot plot was all they wanted to do was have the yield curve listen to them. They were annoyed about the fact they were hiking rates and the long end wasn't going up. So it's interesting today that here comes Mary Daly. Now, she's no longer a voter at the Fed, but she's interesting just saying this. The rise in bond yields might mean the Fed can stay on hold. And what's interesting she's saying here is the need to take further action. All right, there we go. Is diminished because financial markets are moving the direction and they've done the work. So basically, this is what I kind of was saying after the Fed did this. The Fed's problem right now is not inflation. They were just wanting to see the market price in what they had been doing at the short end, and they've done that now with the long-term rates shooting higher. So it's interesting if you actually look a little bit further. It's really interesting to me. The ISM report yesterday or 2 days ago had the prices index. Now, we've talked a lot about this being a really good leading indicator of inflation. This thing was flagging inflation back in like late 2020 before anyone else saw it coming. ISM saw it coming. And the prices index is really weak here. And they basically say returning, all right, the prices index remained in, this is the manufacturing index, decreasing territory, a pretty significant decrease of 4.6 percentage points, signifying a return to price reduction. And then material manufacturing lead times continue to decrease at a slower pace. So basically, it's just interesting to see this is deflationary. Then you look at this interesting article about UPS and FedEx. Customers regain upper hand in the price wars. And they say, retailers are for the first time in more than 4 years winning discounts on shipping costs from UPS and FedEx. So, we're seeing different sorts of things here about the pricing that's happening. Actually, I do want to mention just one other thing I forgot to mention here with the overall market. If we look at the 10-year, we have identified, long-term, the 10-year yield has, kind of a potential level around 5.25 that a lot of people have been looking at, kind of up around here from June of 2006 and kind of 07 as well. So we'll be interested to see if we actually reach that. But from my perspective, there's probably just people waiting. They're watching these levels and they're waiting for some sign that bond yields are done going up. And, I think that we'll have to see if this level is even reached. Part of me thought we're going to wait till it gets there, but I'm not sure really what to, at this point in time. It seems like there's a little bit more of a kind of, at this point, people are starting to not so much, just keep pushing yields higher at this point. But I want to just point out, we might need to get over 5% before people are comfortable really getting bullish on stocks again. Excuse me. And I think especially when you consider the fact that we have a week, with all these events, payrolls and CPI and Fed minutes and all those things, we have a period of time there where people might just sit back and wait till the whole thing is done. And then we could see yields start to move lower. My perspective, though, is that we have seen we continue to see real improvement with the inflationary situation. And the thing is, we highlighted this at the time. Nobody talked about it, but I have to believe that this will be an issue in a week when CPI comes out, is that the shelter costs fell sharply last month. And the other thing is that the core PCE at the end of last month was also month over month was lower than expected. And these are the kind of good things that I think people want to see. So from my perspective, the inflationary, issue is still continuing to improve. And, I think we'll have to kind of see, but the fact that I think the Fed has accomplished what they wanted, according to Mary Daly, by pushing up the curve and inflation continues to improve means that this overall pullback in the market might not really last as long as people think. We could, see a little bit more upside in bond yields and a little more panic and stuff. But then people are going to take a step back and they're going to see downward pressure on inflation, rates pretty high, and I think we have to just realize that we're in that situation here where rates are really restrictive, and there's going to be a point potentially where this process of tightening does come to an end. All right. I want to get to some options because I know you guys love those very quickly here. And, from my perspective, the near-term risk is something like a strong payrolls report. And we have just another beat down. Not significant, but another more of a kind of push to the downside. So I'm going to go to my Option Station Pro. That's kind of what I'm most just kind of watching for. I mean, right now, there's really no signal that the market is in any kind of good spot or anything. Like I said, the signals indicate that if anything, it's kind of consolidating and pausing before it takes a stab a little, potentially lower because of those inside days. So what I'm kind of thinking is, some of these super liquid names like Microsoft, if we look here out to, next week, because like I said, these events are all pinned around the next 2 weeks, the next week and a half. And if we look at something like Microsoft here, a person might be looking at Microsoft, and they look for a drop down towards something like 300, toward the 200-day moving average. You look at a lot of these big NASDAQ stocks and, look at how this came down before, it touched that level and came flying right back. This time it's sitting at it. And, you have the moving averages bearish. This is now looking more like a bearish flag. You can also see that it made a low, a higher high, and it hasn't made a lower low yet. So that, people could be looking now for this kind of continuation and a finishing toward 300, toward the 200-day moving average as well. So if you see something like that being a risk, a person might look to buy something like the 310, 300 put spread, which, has a cost of around $1.90 here. That can expand to $10. So that's the sort of thing where if we have a strong, payrolls report, if we see another push higher in yields, something like this, you can also see these tight inside days. There's really nothing here that's confirming anything that's bullish or a reversal that I can see. If anything, it's just making lower highs. It's just sitting and consolidating. And what it's doing is it's reducing its oversold condition. And if there is something of a continuation to the downside from here, since it really hasn't gone anywhere in almost 2 weeks now, this is a spot where it could get hammered down that next level. So some put spreads like that could make sense. Something like Apple is in a similar situation. Someone could look for this to go up from 170 down to like 165. Now, again, also this one is, when you look at it, it's kind of at the high of its many-day range, but the 8-day moving average is under the 21-day. It's under its 50-day moving average. It's just kind of at the bottom of its, of something of a trend here. This could be interpreted as a bearish flag. So a person here could potentially look at something in Apple like the kind of 170, 165 put spread, for example. By the way, I'm going to change my color. I'm going to make this teal or cyan, and then that way it's going to match whatever I put up on here. And in this case, something like the 170 puts, you can see them here. A person clicking on that can then hold down the control button and click on the excuse me, the 165s, and look, a put like spread like that is something like 55 cents with potential to expand to $5. So that is potential risk reward of potentially, something like ninefold. And it's just to recognize that this is something where if you want that binary event kind of protection, that is what the purpose of something like a put spread is. I also want to take a quick look because another kind of strategy, and we had mentioned this some time back, but a name like Coca-Cola, we were talking about here, and we were saying that it had the risk for like a kind of accelerating, galloping breakdown as support crumbled. And we had mentioned at the time something like, I think we actually mentioned the January 50 puts. And what's interesting here is if you look at something, the idea is when you see something really breaking down like this, you look at these puts, copy the symbol on them. Let's see. Something like this would have, really spiked up. In this case today, it's up, but it would have gone from like 25 cents or $1.25 or something. So what's interesting in something like this, in my view, is I'm looking for some charts that look like this did here. Because the thing is, when you have all these moving averages on top of each other, what does that tell you? It tells you the stock hasn't done anything for 50 days, 100 days, 200 days, because it's on top of those moving averages. So what you often get is you get periods of movement and periods of consolidation. And this basically is a simple way of finding that there's significant consolidation when you're near all those moving averages. So some of the things I've been watching, one of them is BABA. We've been talking about the kind of bearishness in this, but this also has a lot of these moving averages pretty close to each other. The stock's really gone nowhere for a while. I continue to see issues with China. And I think a name like this, a person could even do something in this case. Now, for a strategy like this, sometimes it can make more sense to simply think about longer dated puts that are farther out of the money. You have to recognize buying out of the money options is a decent risk that they're going to expire worthless. But the thing is, if you have a lot of time on them, you don't hold them. I mean, the idea is not to hold them to expiration. So if you look at something like this in Alibaba, the November 75s, something like this, for this value at this point in time, they still have, 2 months to expiration. And, if this thing does break down in the next week and a half, 2 weeks, these will ratchet up in value. And if not, they will lose very little value from time value. After, from time decay. After that, then you're starting, the real time decay is in the last 3 weeks of an option's life. But, for something like that, you would not want to be thinking about holding it much more than that. Now, the advantage of something farther out in time, farther out of the money, is that basically because of gamma, what happens as the stock moves in your direction is the delta increases. So it's basically the leverage will move in your favor as the stock moves in your favor. And if it goes the other way, then you still don't have a lot of delta hurting you because, this has if it goes up $1, these options will lose 20 cents. Now, you don't want to lose that much, but at the same time, it's not a huge amount of delta that goes against you. So the idea of something like this is you have time on your side and you have the gamma that will kick in. And in my view, when a stock is breaking down like this, like Coca-Cola was, it's kind of like, it's a horrible analogy, but it's just like kind of putting tying a rock around, someone's foot and throwing them in the water, and they're going to sink at some point. And that's essentially what happens when a stock has this sort of technicals happening and this sort of fundamentals happening. So a stock like that we recently did an idea on TradingView is Warner Brothers Discovery. They have a lot of debt. They have a decaying business model, and they have space to the downside. So also, this stock's a little bit farther along the way, but you can also see at this point in early September, all the moving averages were on top of each other, and the stock has fallen since then. But this is also, in my view, the sort of name has a lot of debt. You see these junk bond spreads widening. You see interest rates going higher. This is sort of company where their income, it'll be like, the dog ate my income, my net income. Jerome Powell ate my EBITDA, or not my EBITDA, but he ate my net income. And basically interest expense on names like this will reset higher. and it will be problematic. And so anyway, or there's a good chance of it being problematic. And so we're looking to capitalize on these structural of trends, the same way that we were able to identify those opportunities in names like United Airlines back in June, or Carvana back in like May and June. The same sort of thing now is going the exact opposite direction in certain names like Warner Brothers Discovery. And that one, this one to me is one that hasn't moved that much yet. A lot of these others, like the banks and stuff, have. You look at something like Citi, it's just been a real mess. But also, it's still, if you look at it, it's just now at the risk of breaking down to a new multi-year low. Citi's another one that is near earnings. It's a little bit difficult. From my perspective, this is one that it might need more of a snap higher. You can see it already had a lot of its big meltdown. So the continuation here is not as clear in my view as something like Citi, or more likely, or you might have a risk, I should say, of they report earnings and then Jane Fraser says something else. We're going to cut another 1,000 or whatever jobs. We're going to do this or that thing, because they're doing they can play a lot of games with their business in terms of moving things around, selling off assets, putting band-aids on things. So like a stock like this could have a sharp rally, but if it does, that could be the time to be thinking about coming in with on the put side. Because structurally they have a lot of global exposure. The dollar's been strong. They have a lot of debt, and they're just not a well-run company. It's been a mess all along. And, so for things like this, it's often the idea, look for the weak to get weaker. They had a lot of problems with it. They had one of the higher rates of credit card charge-offs, if you look back in the last report that came out. And, companies like this, they have a lot of British, overseas exposure. A name like this, when you think about it, the things I said about worsening debt, recession, stuff like that, people blowing up on their auto loans, all that sort of thing, all that right now, Citi could be a name that has that happening. And also Citi has a lot of options. The one thing, it has very good options liquidity. The thing though is that right now it's oversold. So this 21-day exponential moving average with a Keltner channel, that could be what we want to be looking for, of a move back up toward that Keltner channel, maybe the 50-day, something like that. Some kind of, they probably won't get back up that high. Maybe just a spike up toward like 41 is all she writes on this. Another one that looks pretty challenged to me is Snap. This has been a name that, they just are very, their business has just been not good. And this is a name also that when you look at it, it hasn't really gone anywhere for a year. And the thing is, again, it's been consolidating. And, if this is now setting up for continuation to the downside, a person might just buy like the January 6 puts on something like Snap. The stock's at like 865, but let's look at this. If you look at the January, someone just looking at something like the $6 puts, these are like around 17 cents. Puts like this, the thing is, a person could buy a large number of them, and the bid-ask spreads are so tight. So the thing is if it really starts to move, these are the kind of puts that, what happened? This stock by January, or, December, I'm sorry, let me look at I'm looking at the wrong month. I was preparing notes for myself. Look at January. These are the ones that make more sense in my book. Something like 23 cents. So, these have significant time. They have tight bid-ask spreads. And if a stock like this were to go towards 6 by that time, the other thing is you have the whole window dressing effect, the move into the new year, everything like that. This stock has not been a strong name. So the thing is, if a stock like this goes to 6, right now the stock is at, is over 8. These kind of puts, right now, look, the stock is above 8. And the $8 puts are something like 82 cents. So, those are the sort of puts that could give kind of a significant amount of leverage on this sort of, drowning, sort of move. The idea of just like it's heavy and it gets heavier. The momentum just accelerates lower, like we saw with Coca-Cola, like we saw with the utility stocks, like we saw, with things like Procter and Gamble, which, we had talked about this double top, and it had this just parked at the 50-day, and then it just broke. These are the sort of things where, when you have that space to the downside, and and you just wait. And like I said, it's just like time dragging on a stock that doesn't have relative strength. It can just be the orders flow in and they're selling more than they're buying. And then the trend just works in that direction. That's how trends work. And you can try to, catch the exact move or something, and then you can go crazy and miss it. Or you can use options to have time and have that negative delta and have that gamma that can work in your favor. And as long as you basically remember the fact that those options that, you want to leave, a month and a half, something like that, of time, so you don't get hit by time decay, very often that can be, you can walk away and let time work for you. That is what often can be done, especially when we're in just a meltdown sort of mode. And a lot of these stocks are exhibiting that kind of price action. So before we go on with that, I want to show you this new thing I created to find some stocks like that. And I identify and understand these credit events. Now, remember, we identify 7 essential reasons why stocks move, things like margins, volume, business transformation, but one of those is credit. And this is now a good time to remember that credit can do lots of powerful things to price movement. And, some of these companies that have a lot of debt, they're now in a spot where they are not, they're struggling. And so I think that's another thing to kind of, keep in mind. But let's talk about green energy, because last week we talked about this, and I don't want to be like talking about the politics or anything. This is something that probably sensitive. And the key thing is that there's a trend here. And I can tell you, my background is a journalist, and you know what? I know how to spot when something is happening in the news, and you can see it happening. People start talking about something more, and before you know it, it just spreads and spreads and spreads. And I've got these articles, a whole series of articles here. And these are at a point now, in my opinion, where there's just way too much chatter that is negative on ESG and clean energy, that I think that we have to realize that this trend is, as we know it, done. It's been done, but we have confirmation, I think, now. And when this stuff starts to come up from S&P, this isn't coming from some like conservative anti-green energy thing. This is coming from S&P that has been pushing this. Carbon capture projects in limbo as the economics remain ambiguous. Well, this is what happens when interest rates go up. Suddenly, these things don't make as much money. Here's something, Next Era. This was one of the darlings of green energy with a bunch of wind farms. This stock has gotten annihilated. Now, they're also the biggest utility stock. I think it was NEP. This is some kind of, they do this thing with like partnerships, and I can't remember. I don't exactly remember. It's some kind of limited partnership when they were basically putting wind farms in this entity called NEP, and then they were owning the entity. And well, it worked great until it didn't. This thing cut their guidance. This has been just carnage. I bet you haven't heard about NEP, but this explains a lot of what's actually happened in the last 2 weeks. Is that this thing cut guidance back here, and the utility stocks, all of them have just been hammered. And the thing is, these companies have been investing in this green energy stuff. And I think you have to realize, first of all, it's expensive. Secondly, they issued cheap debt to pay for this stuff. Now, again, they have a lot of debt. And what happens when that comes forward? We already explained. All that debt is now a millstone around their neck as they look at, the treasury yield over 4 or 5%. But then on top of that, companies like NEE, a lot of these things have been set up in these complicated equity joint venture things. So they'll do a joint venture with some kind of other company, and then they recognize the value, that equity at a certain value. And then guess what? When that thing they invested in crashes in value, suddenly you have a big hit on the owning company. So I think there's a lot of things happening here that all go in a pretty negative direction. So I think look at this thing right next year, energy. All right, Larry Fink was a huge promoter of all the green energy stuff. And now he's basically saying we are not going to have a transition unless we can find technology to bring down the cost of renewables. We cannot do that. This is not just like anyone saying this. This is probably one of the single most important people in promoting green energy. And then, so basically, I just think it's important that this is coming together now. And I'm not saying we need to be, shorting them or anything like that, but we need to recognize this was a major theme. There's a lot of companies with exposure to this. It's not as bad as something like Enron, but this is systemic across the utility space, and it's going to hit the banks. It's going to hit a lot of different things, and it's going to trickle through. And my sense is that it's happening. It's been happening, and it's just not done yet. But it also means that going forward, I think we're seeing something interesting. Wait, that's the wrong one. That is not. It was interesting to see that. But what I wanted to show you, where was it? I have the wrong article here. Basically, there was something where coal. Here's another one from Europe, the EU. I had something here where, like, the Germans, someone was bringing back coal over in Europe. I have to find it now, but it was interesting. The Europeans, I think there was a German government, I think, said that they're going to allow like coal mining or something, or no, they're going to allow the coal power plants to come back online. Let me see. I have it on my other screen. I'll find it somewhere. All right, here it is. It's a Reuters article. Germany approves coal-fired plants this winter. So from my perspective here, we've seen this thing, and I'm not saying that like the clean energy idea is over or anything like that. I think it has to come back in a different form. Things happen in waves. My view is that it never made sense to do it exactly the way they were doing it, for a lot of different reasons. It would have made sense to focus on, new plants, are going to be green energy, or this idea of just this radical, aggressive shift. It was just, too much, too fast, and it worked when interest rates were low, and now it's not. And I just think it's important to realize that, because we were talking about coal miners last week, and a lot of them have some interesting pullbacks. And I kind of wanted to mention that some of these, in my perspective here, BTU, CNX, we said last week we thought that energy was something that needed to be kind of understood and be looked at. We said that we thought short term it was due for a pullback, and had the XLE had a really sharp pullback. Crude oil had a really sharp pullback. But the thing is that now they have had that pullback. And I think the question now is, when you really look at it, what is interesting to me is that, I'm not saying Larry Fink per se, but big institutional investors are not going to be ashamed of buying coal miners the way they were 2 years ago, 3 years ago. And I think we need to recognize that this idea, is moving back toward being more tolerant of traditional energy, of coal and stuff like that. So I think right now, a lot of these stocks have really taken a beating. I'm sorry, CNX was another one. They have really been through the ringer. They've been kicked out of the indexes and everything else. And I think when we see the green energy losing favor, and then coal power plants coming back online in Germany, and the Europeans saying things like it isn't profitable, and the IMF warning concern over the energy transition, and all these articles about this weakness, no energy transition, all these things, it just seems like we're having a shift. And I just want to point out that thinking about things like coal and traditional energy and things could make some sense here. So I'm sorry, I need to give me 1 second. I'll be right back, folks. Give me just 10 seconds. Apologize, folks. Okay. Check something. I am back. I want to just point this out because I think, these coal miners and things like that, I think we got to think about them. I listed them in the last market trends I try and identify these trends as they're happening. We identify trends like, what was happening in the consumer staples. And, I would say, just point this out. Early in the year, we said there was a huge structural demand for the housing stocks. ITB was, aside from semiconductors, at one point, it was the top performing industry group of the year. And I kind of, as I looked at things, I remember at one point I made a note to myself saying that energy was going to be the housing of the second half. Why? The reason was the supply demand and the underlying fundamentals. And if you think about something like that right now, we've underinvested in traditional energy. The demand is still there, blah, blah, blah. And I think that, things like, if I told you, people thought I was nuts by saying that home builders look good early this year. And I think, again, if you tell people coal miners are like a good, interesting part of the market, they'll call you names. They'll say you're stupid. But the end of the day is that these stocks are performing and we have things turning in their favor. So I think we're at the beginnings of a turn here that could last a few quarters. And I want to just point this out because this is kind of what it looks like, in my view, when you have this flurry of news that nobody is talking about. It's all like it's buried down the Reuters feed and stuff. All right. Can I create a list of the websites I'm showing you? Not easily. I'm sorry. I can just, so if you want to just quickly just look at some of them, and I cannot easily. This makes it too difficult. But if you just Google some of these things like IMF energy transition, or some of these things. If you Google like this is something Larry Fink said in Germany. I saw no one else pick it up. Oilprice.com is an interesting website. I enjoy it sometimes. Anyway. I follow this lady on Twitter. She's also good for watching crude oil inventories and stuff. Julianne Geiger. I don't know her, but she's been interesting for me to follow. Anyway, I am now going to, let's go back to our summary here. I mentioned the ISM being strong. I mentioned these items here. It's interesting that Intel came out with this sort of strategic actions. They're planning to do a spinoff 2 to 3 years from now. Intel remains a name I think that is interesting. That if they manage to kind of get things in order, they have a significant potential for a comeback. So now the S&P is fighting over that level from that June low around 42.61. We're back above it by a few points. But I think it's interesting. Intel had this thing that is a potential catalyst for Intel. All right. All right. Now, I created this new indicator. I'm going to just really quickly open up a new chart and a new workspace and a new radar screen. Go here. So this thing is called LT debt divided by total. And I'm going to bring in the S&P 500. I'm going to just quickly, I'm going to make this bigger. Let me just go to settings, page, font bigger for you. So what this is going to do is, this in particular allows us to see companies that have a lot of that long-term debt, because this is not something you can know for certain, but it's pretty probable. Companies that have a lot of long-term debt, they issued it in the last, most of it would have been issued in the last 10 years when interest rates were low. So when companies have a lot of long-term debt, it basically means that they have a risk of long-term earnings deterioration, because of the fact that, over the next 5 years, as they refinance long-term debt, and that was the definition of long-term debt, is 12 months and over. As they refinance that long-term debt, most of it are notes that were issued, or bonds. A bond is a note that's longer than 10 years. As that happens, they will be, paying off debt that was costing them 3% and going into a new one at 6% or higher. You know, it's kind of like the whole thing about people who don't want to move because their mortgage rate will go up. Well, if you issue long-term debt and it comes due, you have no choice. So what this does is this looks at three different ratios. It looks at long-term debt divided by total enterprise value. So big numbers are bearish. And then we see right at the top, we see Citigroup, United Airlines, Synchrony Financial, Paramount Studios, Caesars, companies like this, Warner, the cruise lines, there they are. So this basically tells you that a company like Citi, its long-term debt is more than its entire enterprise. And this, they must have cash on there's something about this that makes this different, because I'm not sure about this. This is, see, like, again, these numbers are something to start with. But the thing is, now I would say for a bank, in some ways, it's not as bad, because the bank earns more money in the short term because most of their assets increase with value. So, for example, if they make a credit card loan, that goes up with short-term rates. So in some ways, for a bank, it's the opposite. But if you're an industrial company or utility company, then you're in trouble potentially, because you have that long-term debt. And the thing is, if you look at a name like Apple, Apple has, of their total debt, 82% of their total debt is long-term debt, but they have like no debt. So if Apple has some like low rate bonds coming due, they can just pay it off. They have enough cash to just not even refinance it. But the thing is you want to look for one. So this has three different ratios. It has long-term debt divided by market cap, divided by enterprise value, and then also by total debt. So if you look at something like, a lot of these companies that have a lot, that their debt is lots of long-term debt, things like Airbnb, it's not a lot of their overall cost, their overall capital structure. Their total, their long-term debt is less than 10% of market cap or something. That's not, necessarily problematic. The ones that are really kind of meaningful, in my view, were the things with a long-term debt divided by market cap or divided by, enterprise value is a big number. And so I want to point out Caesars, American Airlines, this OGN thing, which is the old, I think it's the old Bar Labs. It's like the contraceptives that were under Teva. I can't remember, but this is like basically a pharmaceutical. I'm pretty sure they make generic contraceptives. So it's like one of these things that is, that's exactly the kind of business you would leverage, because in theory, it has stable cash flows. When you have stable cash flows, you pile a bunch of debt on top of it, and then you try to do better, but then it works well until it doesn't. It's interesting, if you take a look at OGN stock, it has not been very pretty, as you can see here. So this is, if we look at some of these names, we just quickly do a symbol link between them. And I think we're in a stage here where people might want to just kind of keep thinking about this process working. Now, again, like something like Morgan Stanley, in my view, if it's a financial, it doesn't really apply, like I said, because they're loaning money out at market rates with Ford, for example. BXP, now this is a company that is a real estate investment trust. And, so a company like that, that's going to be the sort of thing that long-term, it's going to be a kind of painful thing to think about. I mean, the nice thing is for people like, ordinary people, if you own a house, after 30 years, your mortgage is paid off. But imagine if after 10 years, you had to refinance your mortgage. Well, that's what it's like to be a real estate investment trust, because they have, standard debentures, which come due in 10 years, and they have to pay the whole thing back. They're not amortizing the way a residential mortgage is. So anyway, I want to just point this out, because this might help us find some of the kind of downside opportunities to kind of just like, cement shoes, like kind of downtrends that, right now strike me as being the kind of potential thing. Can you show the new workspace that was added to the zip file? All right, so I did not add a new workspace. I added an indicator. And let me bring that up. It is LT debt ratios. I think if you actually look in here and you sort, yeah, you can sort inside the zip file. You can actually see this one was added in October. If you have date modified and if you're using Windows, go to view and then view it as details. All right. So I'd also just remind people that I'm not against clean energy. I'm not in favor of coal miners. I'm just looking for trends. There's in the market, anything can be good or anything can be bad. One of my refrains of looking at the market is that nothing is always true. If I told you a few years ago that Apple was going to, that a tech stock like Nvidia was going to be a steady Eddie stock, and next year energy was going to be trading like Lehman Brothers, or I mean, I would say that, but I mean, is going to be crashing like this. I mean, you would have thought that's crazy. You would have said, well, utilities are safe stocks, and Nvidia is a high beta tech stock, and look at it. So I mean, I think it's important to realize that there are certain patterns in the market, but they're not always true. And the thing is that this unwind that the Fed is doing with interest rates, things like this, it's like with subprime or something. In a way, it's not as bad as subprime. It's not related to fraud or anything illegal or anything that is unethical. It's just the fact that these guys got used to low interest rates, and now it's a rug pull. And as there's no more low interest rates, they have structural debt. Utilities have relied on debt financing forever. And, as that universe changes, honestly, it's very challenging for them going forward. And I personally am a little bit worried at a societal level that we're going to have some utilities maybe get into deeper trouble, and that might have some difficulties for the country. Maybe not the country, but like I wouldn't be surprised if some utilities are in a spot when they actually end up in trouble, because of this. Because the thing is, with the demands on them, you look at the stuff in California with the wildfires, and then you look at the idea of them trying to spend money on energy transition, and then suddenly their interest expense go through the roof. All these things together are, something that could kind of squeeze them. So I think we just need to realize that is potentially happening with the utilities. But the other thing is if we get to a spot when interest rates start falling, they could have a significant recovery, but they might still get cheaper before that happens. So we need to be thinking that way and recognizing that there's that kind of, link between interest rates and this sector. It also might not be immediate. Rates might have to fall, and then after a few quarters, suddenly they might all take off again. So just something to be kind of thinking about, looking to the future. As I scan very quickly, I want to mention a few things that did pop up to me here. Kamiko, we did an idea on TradingView about this one, the uranium stock. Been an interesting sort of position. Also, again, winter is coming, and we still have sanctions. The Europeans are still having sanctions on the Russians, and the French have trouble with Niger, whatever, however you pronounce that West African country that produces Niger, I think. Uranium, this is also a name here where I think it's been a real outperformer, pulling back to the 50-day today. This is kind of interesting. So this one was interesting to see this pullback into it. Has been an interesting name that has had some good numbers, and it had this interesting sort of breakout. It's interesting to me to kind of see that it's just kind of holding steady here, and I think this is one we want to kind of watch. It's interesting to see it kind of stair-stepping higher here. I don't know. Software, to me, these names continue to have an interesting sort of performance, and they seem to be in a secular sort of growth phase still. Now, here's a company that does offshore oil drill stuff. Like I said, from my perspective here, these energy stocks have gotten battered, in the last few days. But, I think in the next week or two, some of them, and this name was really outperforming. It's really taken a beating. So, I mean, the thing is, 3, 4, 5 days from now, let's see if it stabilizes. It's down like 4 or 5 days straight. Let's just see what happens with a name like this. I mean, it's near term, it's obviously taking a beating, but in a month or two, will it still be at this level, or will potentially the momentum come back into play on a name like this, HLX? Another name that's interesting is CME. Wow. Well, when I did this article, it was pulling back and holding down here, and now here it is up But it was interesting to me to see this was a strong earnings report, rally, tight consolidation, rally, pull back and hold 200, pull back and hold 200, continuation. CME is an interesting name because they're kind of like, I mean, this stock is just, it can benefit from volatility, and it just seems to be completely on its own. It doesn't seem to follow any others, which is kind of interesting when you're in a market when a lot of stuff is struggling. Marathon Petroleum, there's a refinery stock, really took a beating as well. But again, what's interesting to me is to see, look at trying to hold these levels. Let's see if it holds these kind of levels for another couple of days. But this is now also kind of, potentially oversold, with still finding a new support above the old highs. This was an all-time high. These were all-time highs. So if it kind of holds down there, this could be something in a couple of weeks that potentially people might look for some continuation. AT&T is one that is on the list of being, a company with a lot of debt that might kind of get the suck to the downside. I mean, the thing is that at this point, it's already had a decent move, but if it starts breaking lower here, you have something of a bearish flag. If you look, it kind of had these, if you, like this, broke that. This is one that might be setting up for some continuation to the downside. SLG is a highly leveraged office real estate stock. This is one to me that this is one that also might have some real downside risk into year end. A lot of debt, exposed to office, all the areas that have been struggling. This name is on that list. The other one was Freeport-McMoRan. To me, the copper situation, I continue to believe, well, not believe, but just see that, the Chinese situation is, just challenged, and that's a big issue. But the other thing is, any kind of recession risk, strong dollar, less building in the US, there's a lot of risk, green energy transition, like I said, if that kind of fades. To me, Freeport here is a copper miner. Also, if you look at it, again, we have space to the downside. We basically haven't had a new 52-week high or a new high since January. It's, it hasn't moved much. And the thing is, it could kind of follow the same path as something like a Coca-Cola, or like a Next Era, or like a Procter and Gamble did. I mean, I was even, I want to just point that out because, it hasn't moved much. So, looking for things that could be heavy, that haven't moved much, and that have space to the 52-week low. And the nice thing about this is trades a lot of options. It's another thing that might have that downward suck. So anyway, hope everyone has a great day. I will see you next week. Don't forget, payrolls tomorrow, and then Fed minutes and CPI next week. Take care, folks.